Hey, what's up, everybody? Welcome back to Investing Sucks. So, in this video, I'm going to talk about a company that is currently the largest individual stock position in my personal portfolio, which is EQB. So, EQB is a company that I've actually talked about a few times on this channel, but I haven't made an update video on them in a while now. So, I wanted to just make this video and talk about why this particular company is the largest in my personal portfolio, which also means it's my highest conviction investment right now, and also talk about how the thesis has changed over the roughly 2 years now that I've owned it. But before I get into that, I want to quickly cover what makes EQB a unique company. So they are a bank, they're a Canadian bank, and what they focus on is serving underserved markets within Canada that the other big banks aren't dealing in for a variety of reasons. And it's also a purely digital bank. They actually don't have any physical branches, and all of their technology is cloud hosted, which actually is a pretty big advantage for them, which I'll touch on a bit later. So, as a bank, their business model is based on this risk balancing act where they take deposits from their depositors and then they provide loans to borrowers that they deem are creditworthy. And they want to provide enough loans to make a good amount of money from the interest on those loans, but not too many loans to where they're giving them to uncreditworthy borrowers who aren't ultimately going to pay them back. And every bank that exists lies somewhere on that risk balancing act scale. And the way you can kind of get an understanding of what that is for a particular bank, not just EQB, is you can look at these two metrics and how they align with one another. So the first one is net interest margin, right? So net interest margin is just interest income minus interest expense divided by the total interest bearing loans that that bank has extended to credit-worthy borrowers. So essentially, how profitable on average are the loans that they're extending? And the more profitable the loans are, the more risk they have to take on, right? Which means a higher net interest margin is always going to be paired with a higher degree of credit losses. And the way you can kind of gauge credit losses, there's a few different metrics to use. The one I'm using here is ACL, or allowance for credit losses, as a percentage of loans. So ACL is basically an estimate that a bank will make about how much of their loans they're ultimately not going to be able to collect. So that is a percentage of the total amount of loans, and it's based on historical data and also current economic conditions and a whole bunch of model inputs that go into that. So EQB is very low on this scale. They're very low risk tolerance, and the loans they give have a lot smaller of a margin. As we can see here, then their net interest margin is the lowest of the ones that I'm comparing them to here. And if you contrast that with basically the polar opposite of them, a company called GoEasy, which I'm sure many of you watching are familiar with this company as well, and I did make a video on them in the past. They're very different. They have a much higher margin on their loans. They make a lot more money on a per loan basis, but they also have significantly higher credit losses. And that's just due to the nature of the loans that they offer. They offer unsecured personal loans to consumers, which naturally are going to have a much higher loss rate than something like EQB, which is giving mortgages that have actual security backing them. Another comparable company, Canadian Western Bank, so their net interest margin is a bit higher than EQB's, but we can also see their ACL is higher as well. And then I also included the average of the other big six banks in Canada, which they're pretty comparable to EQB in the net interest margin, but their ACL as a percentage of loans are a bit higher. So you can see pretty much every bank is going to be somewhere on that scale, and EQB just happens to be lower on the scale. That doesn't mean they're going to be less profitable, but it just means that you have to look at them a little bit differently. Now, in terms of the actual loans that they offer, this is important to understand for any bank because different loans have different things that influence the demand for those loans. And a bank's ability to grow their loan portfolio consistently into the long term is ultimately what you need to have success. So, the biggest one for them is going to be mortgages, right? They offer both insured and non insured mortgages. The difference being non insured mortgages had a down payment of at least 20%. So, there's already sufficient equity built up, so no mortgage insurance was needed. And these are alternative mortgages. And alternative mortgages are for customers that the bigger banks won't serve. So these are people that are self employed, people that, for whatever reason, lack a long enough credit history. Recent immigrants is a big one. And I'm sure we all have our own opinions on immigration in Canada. They also have some smaller ones like reverse mortgages, which is included in this decumulation loans category. And this one has been growing very, very fast in particular. If we look at since the end of 2022, this has grown 55%. And there's a lot of demographic trends playing in the favor of reverse mortgages. For one, it's small relative to the total amount of loans that they have. But as Canada's population ages and more people want to tap into the equity that they have built up in their homes, That's what reverse mortgages allows you to do. So the demand for this is pretty strong, and EQB is one of the premier providers of that. And then on the commercial side, there's just normal commercial loans to businesses, there is equipment financing, and then there's also multi-unit residential mortgages, which is apartment buildings and condos. This is primarily in Toronto and the GTA area, which obviously there is a huge need for that right now. Affordable housing is a big concern in those areas, and lots of development is needed to meet the gap. And the vast majority of these types of loans, which we can see, there's this other category down here for the derecognized, which is about 16 billion. The vast majority of these are securitized as part of Canada's mortgage bond program, some of which are even bought by the government of Canada themselves, and then also other institutional investors. So the income that they generate from these loans in particular is comparably much less when looking at the actual residential mortgages. Residential mortgages are really their big moneymaker. So the thesis with EQB, if I could sum it up in just one sentence, would be it is a very fast growing bank that is trading at a very low price to earnings multiple, especially when you compare it to other peer banks within Canada. Now, it trades at a low valuation multiple for a reason. As we can see here, their PE ratio is currently about 7 times versus goeasy, which is about 11.5. Canadian Western Bank is 8, and then the average of the big six banks is just under 13, despite the fact that they have vastly outperformed those companies in terms of their revenue growth. 22.7% annualized revenue growth over the last 5 year period, which is obviously very strong for a bank. Now, it trades at a low valuation for a reason, right? And the reason is because it's highly, highly exposed to the Canadian real estate market, which many people believe to be in a bubble right now. And if this bubble were to burst, that would be very bad for EQB. That would be something that could potentially cause the bank to go under. So I'm not invested in EQB because I think this PE ratio is too low and I'm expecting it to magically expand into the future. Because as long as that risk exists, the risk associated with them being very tied to one specific market in one specific region, then they're always going to trade at a discount relative to their peers, which are larger, more diversified banks. So until they're able to diversify outside of just Canadian real estate, then the PE is always going to look low. It may vary a little bit within that kind of low range, where on the low end it's kind of 6 or 7, on the higher end it's 9 or maybe even gets up to 10, but it's always going to look cheap relative to banks, unless you're talking very, very long term where they can actually diversify their loan portfolio. So I'm not banking on the PE expanding. What I'm banking on is two things really. One is return on equity staying high, which it is quite high. Return on equity has consistently been in the 14 to 16% range, which is it's lower than goeasy, but much higher than Canadian Western Bank and the Big Six average. And then also that fast rate of growth in their loan portfolio to continue into the long term. So let's unpack both of those two factors now. So we'll start with the return on equity part. So with return on equity, the reason why EQB's return on equity is consistently higher than a lot of their competitors is because they're just simply a more operationally efficient bank than the Big Six or Canadian Western Bank, or really most banks you're going to find out there. And one metric that really underscores this is the efficiency ratio. So the efficiency ratio is just simply non-interest expenses divided by revenue. This is a very common metric that a lot of people look at when they're looking at bank stocks. EQB's is in the mid 40% range versus the competitors like goeasy, which is 57, Canadian Western Bank 51, and then the Big Six average of 65%. Honestly, you'll be hard pressed to find a bank that has a lower efficiency ratio than EQB, which means they're more operationally efficient. And a really big part of that is because they're an all digital bank. They're entirely set up in the cloud. They don't have any physical branches and they save a lot in costs by doing that. So that's why their return on equity is always going to be high. And that's one of the big reasons why I invest in them. That's part of the thesis as well. Now, the other piece, the loan volume growth piece, which is a lot more complicated because predicting what their loan volume growth is going to look like, it really depends on the supply of creditworthy borrowers that they can lend to in all the various loan products that they offer, which I showed you before. And more loan volume is going to mean more net interest income in the future and thus more profit. That's kind of the cycle of how that all works. So I'll unpack this part now because this is probably the most important part of understanding the EQB thesis overall. So when it comes to this, At the very top level, you have macroeconomic factors that influence this. The biggest one being interest rates, right? Higher interest rates means money is more expensive, which means loan growth is going to slow down. It's harder to get originations in a higher interest rate environment. And this was one of the reasons why, if we go back to 2022, shortly after I initially opened my position in EQB, their stock price was actually going down quite a lot. So their stock price initially went down significantly in this time period here. It went down. There's about a 40% drawdown in the stock price, but then it quickly recovered after that, right? It went down here and then it went up and even went up to a higher point than it was at previously. So despite the higher rates, their loan volume actually remained stable. If we go back to this chart here, we can see total personal lending, if we look at the end of 2022 versus January 2024, increased 2%. Commercial lending increased 4%. Generally, the expectation at this time was that their loan portfolio is going to shrink because you're going to have this natural runoff of borrowers as they pay back their loans. And if originations slow down to the point where they can't replace that runoff, then the total portfolio is going to shrink. So that's what was expected, but that didn't end up happening. And one of the key drivers of this, if we look at the personal lending part, was these reverse mortgages, which I talked about before. In fact, that was almost the entire growth in the personal lending segment because this went up 55% over this time period. Overall, it went up almost 600 million, and the total growth was about 600 million. So it went 32.1 billion here to about 32.7 billion here. So that was a big factor, right? Immigration was also another big factor. Regardless of what your opinions are on of immigration, it was something that played into EQB's favor and allowed them to keep the mortgage portfolio at least constant, so it didn't decline too much. And this kind of underscores the overall thesis in EQB, which is that there is significant demand for housing development in Canada right now, and EQB is at the forefront of that. And there are some challenges that they're going to have to face in that, whether it's obtaining permits to develop new units or just the availability of labor to construct these new housing units. But at the end of the day, the demand is there. And then also, what we're starting to see is inflation come down in Canada, right? So inflation most recently was reported at 2.7%. So it's getting closer and closer to that 2% target that they have. And once this gets to a low enough level, the Bank of Canada will start to lower interest rates. Now, they're not going to lower them to zero like they did in 2021. I think those days are pretty much behind us. But what I would expect is over the next 2 years to see interest rates slowly but surely come down a little bit. And once that happens, you're going to see housing activity in Canada start to pick back up again. Okay, so the last thing I want to do is try and predict what our returns will look like being invested in EQB. So I have a few different scenarios here, which all have probabilities assigned to them and all are within reason based on what the company has done historically and also what management has guided for in the future, and then also my personal opinion on how this company is likely to perform. So I start with just looking at the book value growth rate, right? So at the low end, we have 13%, 14% in the middle, and then 15% per year, each year over the next 5 years on the high end here. And then we take our return on equity, right? So at the low end, it's 14, 15, and then 16% on the high end. And we can use those two numbers to predict what their earnings will be by the year 2028. So the end of fiscal year 2028. So these are the earnings here. At the high end, we have almost $1 billion in earnings. And then we just apply a PE multiple to that. And I've kept the PE multiples very much in line with what they have been historically, which, like I said, are pretty much always going to look a little cheap relative to other Canadian banks. And then from that, we get our estimated market cap. And then we just divide that by shares outstanding, which by 2028, they'll probably have around 43 million shares outstanding. And we get an estimated price per share. So then I just look at what's the annual capital gain increase per year, and then we add on the current dividend yield. Because if we're just looking at book value growth rate as our base, then that isn't really accounting for dividends because dividends come out of book value, right? They get paid out of retained earnings. So we have to add the current dividend yield of 2% to that. And basically, what we get is pretty strong returns in every scenario. So even at the low end, we're still getting about 10% returns. The middle, which I think is the most likely one, is about 15% returns per year for the next 5 years. And then at the high end, the more optimistic scenario, it could be over 20% returns, which for a bank is quite good, right? The problem with banks is they're never going to grow exponentially because they just simply can't. They have capital requirements they have to meet that regulators are monitoring, so they can't, grow super fast and just extend credit to everyone to grow their loan book too much. But to me, it seems highly likely that they will be kind of in this middle range here. So you can see why I'm so bullish on this company, because it seems like pretty much every demographic trend within Canada is playing into their favor. And I don't really see a scenario where they don't produce at least, say, 10% annualized returns on the low end and 15% on the high end. So those are my thoughts. That pretty much does it for this video. So thank you so much for sticking around and listening to it. I hope you did find it useful and you learned something new. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing. And I'll see you guys in the next video.